In order to succeed as a consistently profitable day trader, you need to have two things figured out above all else. First, you need a concrete psychological and risk management system in place, that way that not only when you make money in the market, you can keep the money you make in the market. And when you lose in the market, you lose in a way that doesn't damage your account completely. Now, in my opinion, this is the most important thing that a trader can have. And that's why I've done several videos in the past, including a 2-part series that I call the best trading psychology strategy out there. If you haven't seen those videos yet, I highly encourage you to go check them out, as they will definitely change the way that you view trading psychology. Now, that being said, while I believe it is the most important aspect of any trader's success, I am also blatantly aware that of the viewers of my content, everybody wants more and more of the second factor of trading, which is your strategic edge. For us, this comes down to, what do you see in the charts? Now, if you were to get a Merriam-Webster's dictionary definition of technical analysis, they would give you some big mumbo jumbo about interpreting price with charts and analyze and meh. But the reality is that the second portion of a trading edge that you need is what is known as a strategic edge. This strategic edge will give you some sort of high probability in terms of reading the charts in order to find high quality trade opportunities. So how would I define technical analysis? It's the use of charts to make money, right? Don't overthink it. Technical analysis at the end of the day is your ability to interpret a chart and identify, is there an opportunity within that chart? Now, when it comes to strategy, I have a variety of different ones that I use. I love trading with the trend. I love using the level-to-level system that you all have heard me talk about countless times. However, in this video, I would like to give you a thorough breakdown of one of my favorite trading strategies that I always use on a daily basis completely for free. Now, in order to give you a breakdown on what this strategy is, the first thing that we are going to need to do is define what's a key level. You hear about it all the time in trading. Support and resistance, supply and demand. It's too much for me. There's these zones that can become confusing. I don't know whether we're expected to react to one part of the zone or the entire zone, or I don't know. It's just confusing. I can assure you that over the course of my several years on YouTube University, I spent years trying to figure out the best way to identify support and resistance level. Now, on that journey, one of the things that I actually found was that there was a free level given to traders every single day that can be utilized as a reference point, as a key level, as an area of supply or demand that is literally given to every single trader out there with no paywall. I'm talking about what we call the opening print. The opening print is the first price that a stock opens at that day. And for the rest of the day or year or forever in time, that level is marked as the opening print. And it comes into play in a huge way each individual given day. Now, a popular question that I get asked is, Jake, does the time frame matter on the opening print? Is it the same on the 1, 2, 3, 5, 15-minute, hourly, weekly, daily? It does not matter. Wherever the time that a stock opens at for the first price that day, it acts as the opening print. Whether you're looking at a 15-minute chart, 2-minute chart, hourly chart, it does not matter. Your opening print will be the same price and same level. So whatever candle you are looking at, look for the open of that candle, and you'll be able to identify where the opening print for that stock was on that particular day. Now, before we dive into the chart examples and break down exactly how you can utilize the opening print in your trading, it's important to understand what is a key level and how do we use them. I actually believe that most traders use key levels incorrectly. I mean, how many times have you been told, when a stock breaks 101, buy calls because it's going straight to 105? Or when a stock breaks 80, buy puts because it's going straight down to 75. I'm sure that many educators out there have used this and taught this in the past. Well, I ask you a question in return, my friends. How many times have you bought calls over that key level of 100, so to speak, and then it immediately fails and you are left with a gross losing position, all because you bought as soon as a key level was broken? In my opinion, this is one of the most fundamental flaws that traders can make, because key levels are not God. For lack of a better term, breaking above or below a key level on one simple break does not guarantee that you'll be able to find a winning or losing trade to the up or the downside. I think one of the things that traders struggle with the most is understanding the difference between watching for a reaction at a level versus taking action at a level. In my trading, what I like to do is always watch for how are we reacting to a certain level, as opposed to just buying the breakout, whether it's calls or puts, because I have seen that bite me in the behind one too many times. So the first thing that I would like to do when it comes to key levels and changing your interpretation of them as a whole is encourage you not to look at them as the end all be all. A key level might break up or down, but that does not mean it's free money for everybody involved. Instead, the way that I would like you to think about key levels and the opening print in particular is as a reference point. If you're able to take basic knowledge of market structure, higher highs, lower lows, lower highs, etc., in between, you are actually able to extrapolate that information in conjunction with the key level of the opening print and identify extremely tradable opportunities. Now, not every single day will you find a clean setup off the opening print. And like any strategy out there, there will be fake outs that you'll have to learn to deal with. After watching this video, I do not expect you to be an expert and to make a bunch of money trading the opening print strategy. However, over the course of the next 6 months, if you consistently watch for this type of action on a daily basis, you will see it enough to the point where you will be able to then identify opportunities with low risk and high reward. So again, one of the biggest takeaways that I would like you all to have from this video is that while the key level can be a piece of information for you on the puzzle, do not treat it like the end all be all as your trading strategy. Key levels are meant to be used in conjunction with other elements of your trading strategy. Now, in this portion of the video, what I would like to do is dive into the charts and show you 3 real-time examples that happened over the last several days where you could find potentially high-quality trade opportunities simply using market structure as well as the opening print strategy. So the first step that we'll have here is to show you on each of these charts where we can identify the opening print and make sure that everybody is on the same page about how we find it every single day. The second portion of this will be me breaking down potential trade opportunities that you could have found using this strategy in real time. Now, the third portion of this video, I'm going to give you a little bit of a secret tip so that you don't even have to mark out the opening print yourself. Your trading charting software will do it for you. With that being said, let's dive into the charts. So first up here, what we have, everybody, is an example chart of the S&P 500, the SPY, from just this last Friday. Now, I'm not 100% sure when this video is getting posted. However, this chart came from July 21st, 2023, and I encourage you to go back on a ton of different charts and examine and backtest how reliable this strategy can be, right? So the first things first that we wanted to make sure everyone's on the same page about is how do we mark the opening print, right? How do we mark it? How do we find it? What is this opening print furu magic DS you're telling me about, Jake? You said it was a free gift from the market gods. Tell me, how so? So first up, what you will see here is this S&P 500 chart. And in order to define the opening print, like we mentioned, let's give it a little bit of a formal definition so that everybody is on the same page. The first price that a stock trades at that day, right? So if we were to look at a 5-minute chart here of the S&P 500, we can see that this first candle of the day opened up right here, right? This was that first candle open of the day on a 5-minute chart. Now, like I mentioned earlier, it does not matter what time frame you are on. The opening print will be the same no matter what. right? So as you can see here, if we were to switch to, say, a 30-minute time frame, we would see no difference in where the opening print was. The opening print is the same on all time frames up until the daily chart, right? So for us in this example, the first thing that we've done is identified, okay, here is where the opening print was on the day, right? The stock, aka in this case, the SPY, ended up opening up at 453.96. Now, one of the things that I always like to mention to my team and to my students is that the opening print is always the line in the sand for the day, right? So let's mark that out as well, just so that we're all on the same page. OP equals LIS, line in sand, on the day, right? Now let's talk about why. Why is this opening print so important, Jake? Why does this matter whatsoever when it comes to day traders? Well, let's think about this from a little bit of a deeper perspective, right? We know that if a candle opens up higher than it closes, it will be red on the daily chart. So let's take a look here at this daily chart right here, kind of move this to the side for just a second, right? Here on this individual candle from Friday, the most recent trading day we had in the market, it opened up at 553.96 and it closed all the way at 452.20. Now, one of the questions that I always like to ask those who are day trading is, if you are a day trader looking to trade to the upside, wouldn't you want your daily candle to be green? Right? Like, if you're thinking about it from a logical perspective, if you're somebody who's a short-term day trader trying to make money that individual given day, if you're going long, wouldn't you want the daily chart candle to be green? Right? Because that means you know that from a daily perspective, buyers are in control rather than sellers on a longer time frame chart. So when we ask the question, what does it mean to say that the opening print is the line in the sand for the day? The way that I really like to think about it is the opening print is kind of like exactly that. It's the line in the sand. If we're above the opening print, I'm going to be more interested in long positions, especially if we've developed an uptrend above the opening print. If we're beneath the opening print, especially if we are in a downtrend beneath the opening print, I'm going to be looking for shorts on the day. And it's really simply what we just talked about. If we have a red daily candle, I'm going to be more interested in shorts. Scroll back to a random day back here, right? Okay, we have this big red candle right there. On that day, do you think you would have rather been long or short? Probably short. And the easiest way to tell would be, are we above or beneath the open? Of course, there's many more pieces of information that you'd want to have when constructing your trade thesis. However, this is one that is very straightforward and easy to tell for everybody, right? So if you are not using the opening print in general, I highly encourage you to do it, because you can look at any individual given day on the SPY and usually find some sort of edge with the fact, are we above the opening print or are we beneath the opening print, right? Now, I'm not saying this is an end-all be-all statement. I want to make that very clear. I'm not saying that beneath the opening print you can never go long or nothing's ever bullish. That's not necessarily true. Something could very easily be pulling back to support and then get back above the opening print a little bit later on. However, most times what you will find is that the trades that are the least stressful to you are the ones where you are long above the open and short beneath the open, right? That being said, if it was just that easy, literally everybody would do it, right? If it was easy to go long above and short below, everybody would do it. So instead, what we do is take that information I gave you earlier on in this lesson and use that level, aka the opening print, as a reference point. We use it for a guide to identify, is there a trend developed, and can we use that opening print to potentially find an entry with that trend? So in the rest of the video, what I would like to do is show you 3 separate examples of 3 separate time frames where you could have found potentially valid trades using the opening print and market structure as your key reference point, all right? So first, you can see here that the market is in an intraday downtrend. Now, you could argue that this is a little bit of a range, less so a downtrend, but in my opinion, given that we spent the entire morning beneath the opening print, I'm going to reference this more as an intraday downtrend, right? From here, you can see on the 5-minute chart, we get some aggressive action beneath the open early on in the day, right? However, that moves very fast, and if you're somebody who doesn't like trading the initial parts of the day, that could have led you to be in a position where you don't want to enter a trade that early. So instead, if you are using this as one of your strategies, it will ultimately require some patience as you sit here and wait for an opening print retest to potentially give you a gauge of some action that may be to come, right? Now, in this very first oval that I'm going to mark out here, what you can see is that we put in an overtly bearish candle after retesting the opening print, right? Now, after defining our rules of looking for at least an intraday downtrend as well as a reaction at that level, here we can see we have a solid example. We see an intraday downtrend, a rejection of the opening print, and that would give us validity to look for short entries to the downside, right? Now, again, there's much more that comes into trading when it comes to managing a position, how to take profits, all that. Unfortunately, this video would be too long for me to go into all of the details of that. However, what this video will do is give you a very solid potential system to use for entering a trade, which is most often the most difficult part about trading. So as you can see on a 5-minute perspective here on this chart, we have a rally up into the opening print as well as an intraday downtrend, which means that it is valid to be looking for short positions off of the failure of this opening print. That leads you to a nice intraday pullback that could have capitalized a nice move. However, it definitely would have taken a little while for this move to process, maybe about 45 minutes to an hour of holding. Now, in this example here on a 5-minute chart, you can see that the SPY has created an intraday downtrend. Now, during the intraday downtrend, using this opening print strategy, the early morning action was a little bit fast. So you'd have to be patient, waiting for this pullback and being extremely disciplined, waiting for that pullback to the opening print. As we can see on this chart, within the intraday downtrend, we do end up getting a rally to a 5-minute candle here that is overtly bearish, putting in an inverted hammer that ultimately ends up leading to a very solid intraday short based on this 5-minute chart rejection of the opening print. Now you can see later on in this chart, we actually do get a rally up into the opening print once again, and another inverted hammer signaling bearish action on this chart at the opening print. So let's say you went short here with a stop above this candle's high. While it does briefly get back above the opening print there, it actually does not trigger the stop loss of this red candle here, thus leading to another awesome intraday short opportunity on the SPY using an opening print rejection, right? However, the one thing that I will say is that I know this trade is not a scalp or a short-term trade. This trade, in order to maximize your profits, you're likely going to be needing to hold that trade for at least 20, 30 minutes, maybe even up to an hour. Now, I know not everybody is comfortable with that. So one of the things that I want to make sure is clear is that this strategy works on various different intraday timeframes. Let's say you're somebody that prefers to scalp trade. For whatever reason, you struggle when you hold a position for more than a couple of days or a couple of minutes even at a time. This strategy also works on smaller timeframes such as the 2-minute chart. Here we can see, for example, that NVIDIA had a relatively strong open this day, kind of going sideways, potentially looking to move higher early on in the day. Now, the first thing that happens on this chart is a spike beneath the opening print here that then gets back above the open. That itself is one of my favorite setups, but it doesn't provide us with a super clean opportunity to see a reaction directly off the opening print. However, a few minutes later, we can see on this 2-minute chart, we get several pullbacks that hold the opening print. On this trade, you ultimately could have taken an entry above this bar's high with a stop beneath its low and caught a $5 move on NVIDIA, which on a Thursday on weekly expiration options contracts, you are likely to have made 60, 80% on that move on your contracts, right? So we can see that later in the day, NVIDIA does sell off beneath the opening print here. However, early on, this little 2-minute action provides a very solid entry for your trade up into the high of the day, right? Now, there's many other things that come along with trading, and a great entry is not the only thing. You need to determine when to take profit, how to manage your position, and unfortunately, this video is already running longer than I anticipated. However, this entry system here, using the opening print, provides a very high-quality trade opportunity on the 2-minute time frame. So we've explored the 5-minute time frame. We've explored the 2-minute time frame for those who are better in short-term trades. But what about those of you who don't have time to be watching the market early in the morning? What about those of you who don't do well in quick, fast trades early on in the morning? Does this strategy still work for more intraday trades that are a little bit slower paced, mainly for those who are not able to watch that early morning market? My friends, I'm here to tell you that this strategy, again, works on a bunch of different time frames. And here you can see on Friday, Google has done the same thing that we just talked about on SPY on the previous slide. Google creates an intraday downtrend. As you can see here, we set a new low, get a little bit of a rally, come back and set a new low again, thus establishing our intraday downtrend. From there, Google gets a pullback in a rally right to our green level opening print here, thus offering a short opportunity to capture a move back down in Google based off of this 15-minute chart. Now, this isn't the most amazing example of the world, because in a dream world, you would hope that this trade continues lower and you make even more to the downside. However, what I will say is that I really wanted to show you all 3 separate charts with 3 separate time frames, all that occurred over the last day or two of trading action, and so that you can see these setups occur frequently in real time on various time frames on almost a daily basis. Now, what I will say is, while this is an amazing strategy and you will be able to find a ton of different entries using it, one thing that I would recommend, and I absolutely hope you take away from this video, is I don't expect you to be an expert at this right away. I think that would be a pretty unreasonable expectation that you watch one YouTube video on one strategy and next thing you know, you're an expert at it. So rather than trying to be an expert, rather than using your entire account on a trade the day after you see this video, what I encourage you to do is use this as a piece of information that you begin to study. Take what I've told you in this video and start to examine charts on your own and see if you can identify these opportunities in real time. If you are able to identify these opportunities in real time over a consistent basis of a couple of weeks, a month, 2 months, 3 months, then all of a sudden I would start integrating this as one of your core trading strategies. Because for me, as someone who has been day trading for over 5.5, coming up on 6 years now with over 7 figures in profit, I can tell you this is a strategy that I use on a daily basis. I hope you found some value in this video. Make sure that you click that subscribe button and let me know in the comments what you'd like to see from me next.